Hey everyone, Nick here looking at bank stocks, all because they're going to be reporting earnings soon enough. And usually there's nothing usual about these days, but usually it is a when one bank reports, the whole bunch move in sympathy. And they haven't had a good record on reaction. They pop, but then they can't hold it. With the exception of this one, maybe two earnings ago when they popped and rallied, but the markets were really happy. Let me see here. The last earnings report, they popped and then faded. So this time around, it's completely blind. We don't know what the hell's going on. So it is a complete gamble. If you're in the group already, a member, then you saw the recommendation to go long Wells Fargo and JPMorgan. Well, the JPMorgan trade was just a blowout in a good way on Thursday. And, I booked it a day early, but it was already like a double or a triple. So whoever stuck it then made a lot of money on it. But I was still also long Wells Fargo. So net, I'm long Wells Fargo into the earnings for free. I booked my JPMorgan. I'm not making calls on it that, okay, it's going to go this way or another. The reaction for the earnings, so here's a point. The reaction for the earnings is completely binary. We don't know what they're going to say. We don't know also what the market is going to do with that information. So it's a double blind. We can't forecast the next day what that bank is going to do price-wise and how it's going to go on after that. With the Federal Reserve messing around with the rates long and short, everything's out of whack. I'm going to show you something. This is, you remember the yield curve inverting headline? Oh my God, the yield curve has inverted. That was here. When the ratio between the 10-year yield divided by the 2-year yield fell under 1, which meant that it cost more money for somebody to borrow short than borrow long. So the banks who borrow short in order to lend us long, so they borrow, say, on the overnight rate, and they make loans to us at longer to buy a car, to buy a house. If you invert that situation, that means they lose money because the short-term rates are higher than the long-term rates. In this case, that's what happened here. When CNBC, yield curve inverted, recession is coming. All right. Well, look at the yield curve now. It is not inverted. So because the rates fell to zero on the short term, right? The Federal Reserve said, that's it, surprise cut before their meeting. They didn't even have the meeting. They didn't have because they had went to zero. So there's no decision. They went to zero. So the short term rates got shellacked. If you were in an adjustable mortgage, you're happy as clams. So now it is, that thing is out of whack. So I don't know what the NIM, whatever net interest margin that everybody talks about, how that's going to play out. I doubt there are any experts. So the only thing we know is the chart. And this chart looks bullish, but headed into resistance technically. Why? So this is JPMorgan. This is the best of the best. That's what Wall Street believes. Okay, so what about this tick? What happened here? Back on March 13th. Huge up day, huge reversal. So look where we at. Exactly at it. So this wasn't a coincidence where it stopped on Friday. That was my target. It hit the target. I booked early. I'm fine. This is a complete indecision right in the middle of a gap. So talk about a crap show. If I were to build a box, I'll say, what happened here? What's going to happen here? So the earnings is going to be either beat it or back down. I'm going to say something that's going to sound bad. I hope it falls, but I don't really. I want nothing to happen. But if it wants to do something, it makes more sense to drop a little bit to build a better base to continue on forward. Otherwise, you're going to be froth on top of froth on top of froth, and then giant drops. You need it to make sense. So the earnings are coming first, which is rare. I don't remember it being first. Usually it's Wells Fargo, Citi, and somebody else, and then the next day, and then Goldman Sachs. And so here's the thing. I usually say, if I wanted to bet on JPMorgan, I would bet on Goldman Sachs, which reports later. Because if JPMorgan's disappointed action, it falls. And if I bought calls in it, they're out. They're dead. On the morning it opens, the calls are gone. Why? Because the price went away and the event went away. So the IV, the implied volatility in that option that I bought is going to go disappear. And just from the event going away. Forget about that I got the direction wrong. So Goldman Sachs will fall, but the premiums won't disappear as fast because that event is still on the board. So if JPMorgan falls and I bought calls in Goldman Sachs, I'm going to lose some money, but I'm not going to lose all my money because its event is still to come. So that's the concept. So look up the information on which the reports when, and I believe I had the picture here up somewhere, so let me go find it. All right, too many monitors. Where's my mouse? There it is. Okay, so we've got JPMorgan, Wells. This is an interesting, I want to see what they say. This is, by the way, so I don't take credit for it, Earnings Whisper. And so this is JPMorgan and Wells. And those are the two I was long. Well, now I booked this and I'm long this for free. How's that? I had two trades. I booked a shorter term one, which pays for the one I was holding. So now I'm holding an asset that is green, very green, like more than a double. And I cashed in enough to actually cover the cost of it. So it's not even, there's no denominator. The base price is less than zero. So I could bet on Citi, I could bet on Bank of America, or Goldman Sachs. So they report after. So at the Tuesday open, these premiums are going to disappear if I guess wrong. These premium will get hurt, but not by as much. You know, I don't mess around with these guys unless you know the smaller banks. Then it's just a gambling. I don't know. There are other things that are reporting, but this is about banks. Like ISRG is pretty interesting. It's a good long when it gets hammered. So, all right. So I'm going to X out of this window, back to this one. All right. So while I'm here, I'll just run through the banks. So this is one, and the other one is Wells. You can see how it's coming up to this box. What is this box, I say? And these are just collections of candles that stick out. Like this one right here, that line is important. Why is it important? Because it's an indecision point inside of a gap. What is an indecision point? It's where the market opens somewhere. And this is called a doji. It looks like a plus sign. It opens here, it rallies, it falls. They don't know. They go back to the middle. So they go, I love it. No, wait, I hate it. No, wait, you know what? I don't know. So let's just close it where it was. Usually it's like a punt. I don't know what I'm doing today. Let's decide tomorrow. And usually the next day it's double the size, usually, roughly speaking, because they want to make up both days. Because they say, oh, yeah, I get it now. So let's go that way. So it's coming back into it. Again, not a coincidence where it's coming. And I bet you we can probably find a similar, whoa, no, I guess we can't. Monthly? There we go. All right, so, okay, perfect. So I had to go to a monthly to get a relative price from before. And look at it. That green line is current price as of Thursday's close. Tell me the markets have no memory. Tell me charts don't matter. Go ahead. Tell me it's all about the fundamentals. No, it's not. The fundamentals matter, but the charts matter more too, at least as much. So where it's fading or stalling is not a coincidence. Look at how these are monthly ticks. Every candle is 1 month. 1 month. So they were wall, great base. They didn't even come back to test it. They have the same concept up here. So this is another line I should remember for next time. Somewhere around here. Actually, I could make it lower. Anyway, you get the concept, right? So if I wanted to drop it to here, that would also make sense. Well, oh my God, it makes so much sense. Look left. In fact, I should extend it left. 100? We'll cover it. Yeah, definitely. So you see the visual lines? So if I wanted to do this same line, copy V, I'll put it here somewhere. And that's that little tiny line I just drew. I don't want to put it on top of it, then we'll get messed up. All right, so back to the daily. So you see where we're at. It's visual area of contention. This is probably an overshoot, but that doesn't mean it's the bottom. We don't know what they're going to say. I have no idea what their P&L is going to look like. It might be jaw-dropping. It's like, what? They lost how much? Or what? They didn't lose anything? So we don't know. It's going to be a binary thing. So gambling, really. But luckily, I'm gambling for free. So I'm happy with that. And my bet is out in time. So I can take a couple of red ticks on it and still be okay. All right, so that's one. JPMorgan we just looked at. It hit halfway of my upside target, so it could go more. What about Goldman Sachs? Let me reset this. It's being wonky. Oh, shoot. Okay, I remember that. All right, so Goldman Sachs, I had, when it was up here, I said I want to short it, but then I got scared out of it because of Apple credit card. I said, I bet you it's drawing out and it's going to drop big time. And it did drop big time, as much as I said it would. But I didn't play it because I got chickened out of it because I had a big unknown. I didn't know how the retail aspect was going to hit it. It had something new, and I didn't have a high conviction, so I did not short it. I should have, but I didn't. So it's not out of the woods, I don't think. It's inside of a multiple different time frame things that coincide at the same place. It just scares me. Visually, that looks like about halfway of the drop. If I wanted to talk Fibonacci, I don't usually trade based on him, but his ratios make sense. Look how close it is to halfway point. That's half of the crash. So if this was a crash, they already recovered half of it, and it's a natural stopping point. Moreover, that's a Ben Bernanke word that I learned, and I can't stop saying it. Okay, so. In addition, if I extend that funny candle that I just drew backwards, you can see how it was a base lost. So when they come back to that base, prior support becomes forward resistance. All these there's a reason why they exist, these adverbs, I guess. So if you haven't taken profit on your perfect bounce of, oh my God, 40%, then you're being piggish. So that's Goldman Sachs. Who's else? Citi, not my favorite. Feels like they have a lot of exposure to Europe that I don't know about. I don't know. Goldman Sachs is the wild child. I don't know what the hell they're doing. They used to be a trading bank, and now they want to be a retail bank. So kind of limbo. If I were to bet on a bank, it'll be JPMorgan for the financials of it. It'll be WFC for the surprise of it, because it's still a bank. BAC, I worry about it. I like selling puts on bad days, but I worry about it because it's too easy to do some stuff with this COVID stuff. If you log into the platform, there's a button right there. It says, if you want to defer your mortgage payment 3 months, click here. If it's that easy, what's it going to do to their P&L? I have no idea. So it's kind of scary. Maybe it's the next P&L. I'm not sure. So big unknowns. And again, look at this, all back to pivot points. So in my opinion, onus is on the bulls to prove the sellers wrong. So if I haven't booked bank profits yet, I'll probably lock in the profits. How do I lock in profits? If I own shares in Bank of America, I would probably sell covered calls, no naked selling calls, to try to generate some income and maybe build myself a buffer. What does that do? It just brings in some money, and if the stock falls, that money is mine. It offsets some of the losses of the drop. If the stock rallies, that's fine, as long as it doesn't rally past my share, my sold put a call. So what's the risk? If it rallies through my call and I get called away from my shares, what does that mean? I'm forced to sell them. So I keep my money, the extra money I made, and I have to sell them. I keep gaining until where it's gone. So if I sell the 28 call, then after 28, somebody else owns my shares. So I get to participate another $4 or $3, and then I have to say goodbye. So worst case scenario, I make money, but not as much as I would have made if I didn't sell my shares. But meanwhile, it's a good trade-off. It depends on the tax situation and all of that. So selling covered calls, that's one way. I could sell the calls and buy puts and be protected for free if I own shares. So I sell covered calls and buy puts from them to cover me for the period of time. So that's one way I can do it. But I really don't know what's going to go on. I could make the bet on XLF, a blanket bet with the XLF. Oh my God. Okay, so this is a weekly XLF chart. Look at this candle. Oh my goodness. I mean, this one right here. So, talk about a doji. This is a week, the whole week's action. So, they opened the week here. Some point during the week, they said, you know what? I love it. No, wait. I absolutely hate it. They turned around and sold it down to $3 on a base of 23. That's a big drop. And then they said, you know what? I have no clue. Let's go back exactly where we came from. So they stopped exactly at this point. Now look left. Look how important that point has been in time. The 2018 Christmas crash, the base of this whole rally. So if I were to draw a line here in the center of this funny week, tell me this is not a visually important point in time. Ooh, man, okay. I'm sure you're as excited as I am, right? So if I drop this, nope, wrong one. Sometimes the way I drew the line backwards, so I'm going to put 50. Okay. So I simply extended, look at this. When was that? 2008. Holy moly. I'm glad I did this video. Oh my gosh. Okay, so I'm going to go to 3 months to go to quarterly chart. All right, so now we're talking 90s, 1999 on back. This is that yellow line. This was the 2008 stopover before the dip in the crash. Look at what happened here. 2003, look how much of a wall that was up until 2003. And then they busted up. They defended it 1 or 2 times. This 3 months, every candle, 3 months, 3 months. And then they came back here and then collapsed. How long it took them? They closed below that trend line 1 time. And this ongoing quarter, they're above the neckline by a hair. But they're inside. Like if I extend this guy right here, this way, they're inside that. And I'm going to probably put, what, 10? Boom. So it's a sticky zone. They don't usually slice through zones like that. That alone is not a reason to short it, but that alone is a reason to book profits if I haven't done yet. Okay, these boxes were important, obviously. Boxes, ellipses, and I could extend them. Look what happens here, right there. Are they going to come into play again? And here's the scary part. If they do, what's going to happen? Again, these are 3 months each, so it's a slow moving chart. What if we dip here on some sort of a headline, bad, and then they do this? And if they lose that, then they might do this. They come back to this point in time right here. That's also important. I'm not calling it down there, but I'm calling if we have a disaster earnings report, if we have a disaster economic report, minus 30% GDP or whatever, and it persists, it's not entirely crazy to see it in the high teens. So keep that in mind. That's my opinion. I'm not saying it's going there. I'm just saying I have to be open. And I'm glad I'm long with house money. I'm glad I had the balls to say buy it here, long here. And the way I went long is different than just buying shares. I'm pretty sure I suggested I was doing calls or debit call spreads. I think JPMorgan I chose calls, and Wells Fargo I chose wide call spreads. And I may have suggested selling puts or put spreads too for somebody who wants to own the shares. I did the same in Boeing and such, but this is banks, and so it makes sense. Oh, Walmart, Target, Costco was also a good strategy. But now the easy run is over. Also, if you believe in some sort of a 3 pushes, this is daily chart. They had 1 push, they reverted, and they had another push about the same size. Makes total sense that they fade this zone. But the earnings could call me a liar. Anyway, so Nick signing out. It's 20 minutes. I meant to do like a 10-minute video, but I think this is more informative that way.